Hello, this is Joshua Stewart. I'm presenting my investment portfolio for Finance 32020, Investments 1, taught by Dr. Farouk. Starting off with this assignment, we are given $100,000 to invest, and no additional payments will be made on this. So this $100,000 is given upfront as a lump sum. With this $100,000, I will look to create a retirement portfolio for myself in order to get ahead on my retirement savings. Obviously, with this, some of my main objectives with this goal is to obviously increase the value of the portfolio that I hold. I will look to do this across a timeline, as I will obviously get into later, in order to meet my goal. And with that, I'll need to hit a target annual return over the time. Obviously, some factors that go into this are the economic forecast of the United States, my personal risk tolerance, and my view on market efficiency. Elaborating on my main goal, I am obviously looking to create a retirement portfolio for myself. According to Fidelity, the average American needs $1.7 million saved in order to retire. So my goal is to grow that $100,000 in order to get a head start, on retirement savings. In the end, I hope to raise about 25% of my retirement savings need, which is about $425,000. So I look to increase my portfolio times over 400%. With that, I obviously have a need for a portfolio value increase. I'm looking for something that is realistic. I need something that I'm able to do year over year until my retirement goal. And looking at that, if I get a 5% return on my investment, that equals over $430,000 after 30 years. This will be our minimum return goal. As I stated earlier, the timeline for this investment is going to be 30 years. I kind of got to that number based on the common retirement age for Americans, which is around 65 years old. But with getting this $100,000 as a head start, I want to lower that retirement age so I have more time in my future to play golf and enjoy my final few years of life. So I want to retire at 52 years old, and at 22 years old right now, that gives us a 30-year timeline, which takes us from the years which we are currently in, 2019, until 2049. And to fit that timeline, we need to hit our annual return of 5%. And in looking at an annual return that I wanted to be a benchmark, it obviously had to be realistic. I obviously would love to double my money every month of every year for the 30 years, but unfortunately that is virtually impossible. I chose 5% because getting 5% back every year for the 30 years is sufficient with my goals. I needed a return that will help me reach that $425,000 amount after the 30 years. And in doing so, I needed to make sure that my goal was sustainable. I obviously needed to earn something that I could earn year after year over time so that I am not planning to earn 100% in the first 5 years and then zero after. And now going into the factors that will affect our investments and our investment decisions, we first look at the economic forecast of the United States. This economic forecast can be shown by indicators. Indicators can show what will, has, or is happening with the economy at any given time. There are three types of indicators. First, lagging, which show what happened to the economy in the recent past. There is coincident indicators, which show what is happening with the economy in its current state. And there are leading indicators, which show what will happen to the economy in the near future. First, looking at the lagging indicator in the United States economy, we look at the average duration of unemployment in the United States. And as you can see in the graph, at the top, the average duration of unemployment in the United States has been slightly up and down over the last 30 years or so. But however, over the last about 5 to 10 years, it has dropped significantly. That is because if you can see kind of on my graph, if you see in the year 2011, 2012, the average duration of unemployment in the United States was very high. This was due to the recession of 2008. And you can see since then the dramatic decrease in the average duration of unemployment back to the uh, levels before the recession of 2008. So looking at that, we can see how the economy has grown and gotten stronger since the 2008 recession. Looking at the coincident indicator, we look at the current United States unemployment rate. The unemployment rate is obviously the rate of people who are unemployed but still looking for work. And as you can see, the unemployment rate in the United States has dropped significantly in the past few years. It's currently sitting around 5%, and which is close to ideal in the economy, because the ideal unemployment rate usually is estimated to be about 4% due to what's known as necessary unemployment based on cyclical or frictional unemployment, which happens pretty much consistently in any given economy. And looking at the leading indicator, which can show us what's going to happen to the economy in the near future, we look at the interest rates. And to look at the interest rates, we first look at the United States federal funds rate, which is the rate that the United States charges banks to loan money. And as you can see at the bottom, from the year 2016 until 2019, that rate has climbed significantly. And as I'll describe later, as the higher the interest rates go, the lower that the economy and how it is for consumers goes. So as you can see, that increase from 2016 to 2019 is kind of alarming. But as you can see recently, which is the most attractive number for us, recently that number has dropped back towards that level that it was in around 2016. So although the economy may have faced some turbulent times in the recent past, i.e. last December per se, we can see some bounce back in the economy that we can expect. Another factor that we will look at is my personal risk tolerance. My risk tolerance was measured by a survey created by two PhDs at the University of Missouri. And in that 13-question survey, it gave me a risk tolerance score of 29. And as you can see to the right, a score of 29 in the risk tolerance survey puts me in the bin, per se, of an above average tolerance for risk. But being at the very, very low end of that bin, I will say that I have a slightly above average tolerance for risk. And so this shows that I'm willing to trade slight uncertainty in my investments for potential higher returns. And over time, I'm confident that the return will outweigh the slight extra risk, and also that I don't mind slight volatility in the future. One final factor I'll look at in my investment decisions is the market efficiency. And as we studied in this past semester, there are three types of market efficiency. There's weak form, semi-strong form, and strong form. Personally, I believe in the semi-strong form of market efficiency. These are for basically two main reasons, and that is one, a lack of certainty in fundamental analysis. I do not believe that you can base past prices or past movements of a stock in order to gain any sort of advantage in the future of a certain stock or a certain stock's price. I think that stock prices are so volatile, and no one knows what's going to happen in the future. In addition, I believe that the market reacts just about instantaneously to new information posted about a stock or a stock's company, and I think that all public information is just about immediately shown in the market's price. With the semi-strong form of efficiency, I believe that I can keep risk low for me in my investments in the future. In looking at the market, one industry that I believe has a very high potential for good returns in the short term is the energy sector. The thing about the energy sector is that it is being held down right now by the low cost of oil in the United States. The cost of oil in the United States and the performance of the energy sector usually move together in unison, as the energy sector is basically tied to it. However, recently, the energy sector has underperformed the price of oil and is bound to rebound back to moving in tandem with the price of oil. I think that the energy sector has very high short-term gains, and that is a very good thing to look at in the short term. In the long term, I think that the consumer defensive sector has always been a strong industry to look at for the long term. And the simple reason is it is very resistant to economic downturn. When the economy is down, discount stores and other defensive market sector companies are resistant to that downturn and can help stabilize the return over time. Another one is the financial services sector. According to Morningstar, the financial services sector has the greatest probability of long-term outperformance. But going with that, it also has a higher volatility over time. But I believe that we have the above average strategy and the above average tolerance to be able to move past that. Looking at our portfolio specifically, we have $100,000 to allocate into our investments. And with our risk tolerance score, as I'll get into more later, we will be heavily weighted into bonds and funds at about 44.2% each. And that leaves us with investing in stocks with about 11.6%. I'll explain more onto the percentages of why we chose each percentage shortly in the future. Looking at the stocks that we will invest in the short term, one thing going with the energy sector, I think that Laredo Petroleum Incorporated offers very high upside. LPI, as known as with its ticker name, has a 5-star rating according to Morningstar, and the price as of 12/12, which is today, the most recent close was $2.60, but according to Morningstar, the fair value price is $5. So that shows tremendous upside and potential gain in the short term to reach that fair value price. And looking at its key ratios, it sits below industry average in two main ones. Starting with the price to book ratio, it has a PB of 0.52. This is significantly below the industry average of 1.1. And the price to sales ratio, LPI currently sits at 0.66, with the industry average, being 0.73. With both those numbers being via CSI Market, this shows that this stock, has tremendous upside to bounce back in the future and provide great returns. And with that, our expected return for this stock is up to 100% based on the last closing cost and the fair value price, along with the price to book and sales ratios. One thing that could spark this increase in the stock would be the increase in oil prices. As we said, oil prices, although it being low, is great for consumers right now based on low gas prices and low prices for things such as plastic. An increase in oil prices can help boost the stock's performance in the short term. Another one for the short term is Aurora Cannabis Incorporated, or ACB. This also has a 5-star rating by Morningstar. Its price as of today is $2.45 with a fair value price of $8.50. That is significant. The price to book ratio of ACB is 0.76, but the industry average is a staggering 7.58. So that shows that this stock is tremendously undervalued. In addition, the 3-year annualized revenue growth for this company is 456%. So it has grown over 3 years by 4 times. That is astonishing. And looking at those numbers, in addition to the fair value prices, the expected return of this stock is up to 500% for us. And looking at the long term, One thing that we will look at for consistent long-term growth is Anheuser-Busch InBev. Everyone in St. Louis's favorite beer brewer. Anheuser-Busch has a 5-star rating according to Morningstar. Its price currently sits at about $78.77 with a fair value of $116. Falling into the consumer defensive sector, this is defensive to recessions, and it is very cyclical in its nature. Beer manufacturers have a tremendous busy season between the late fall and about February of every year due to every American's favorite thing, football season. This continued cycle of high revenues gives it a defensiveness to economic downturn that we are looking for. Looking at it, we are expecting a return of 30% for Anheuser-Busch. Moving on to bonds now, we will look for a bond to match our 30-year duration of our timeline, and we will find a United States Treasury bond rated AAA by Moody's with a semi-annual coupon rate of 3%, which is greater than the federal funds rate, which currently sits at 1.75%. The price of this bond is priced at 114.218, and the total yield to maturity of this bond is 2.325%. So we are expecting obviously near as great returns on this bond as we are the stocks, but being rated AAA, the risk in this bond is significantly lower. It's almost minute. With this bond, the price will lower in the future if the federal funds rate were to rise to closer of the yield to maturity. In fact, if it rose above the yield to maturity, the price of the bond would be sold at a discount, so it would be under that 100 price mark. In addition, we will find a Intel corporate bond. This is also a 30-year bond expiring in our target year of 2049. This bond is callable in the month of May of 2049. This bond's coupon rate, on the other hand, is 3.250%. Obviously, again, greater than that federal funds rate of 1.75%. The total yield to maturity of this bond is 3.152%. And so it gives us a annual coupon rate of about $16, just about there, twice every year. The price of this bond is 101.893, and the rating of this bond is slightly lower. According to Moody's, it is A1, and according to the Standard & Poor's, it is A+. So there is slightly more risk in this bond. However, it's still a very good looking bond for our investment goals. In looking at funds, we'll look at Invesco Oppenheimer Rochester High Yield Municipal Fund Class A bond. This has an annual return of 8.17% over 10 years. And looking at the risk of this bond, the standard deviation of this bond is 4.15, which gives us an annual return anywhere from about 4% up to 12.3% per year. The Sharpe ratio of this bond is 1.99, which, as we know, a Sharpe ratio greater than 1 is considered good, and a Sharpe ratio of 2 is considered very good. So this looks like a very good bond so far. The Sortino ratio is 1.6, which is more towards average. So, I mean, in all these three measures show that the risk is still relatively low. And looking at the returns for this bond, they look very, very high according to Fidelity. It is 5-star rated. Although the expenses are relatively high, we are able to move past that based on the low risk and high returns. And looking up of the makeup on this bond, or excuse me, this fund, most of the makeup and the composition of this bond is in domestic bonds. About over 80% of this bond is made up of domestic bonds. In addition, this fund is also made up of a significant amount of foreign bonds and then some slight cash of about 1%. Another fund that we will look at investing in is Nuveen Preferred Securities and Income Fund Class A. This fund has an average annual return of 8.79% over 10 years. It has a standard deviation of 4.07, so that gives us an annual return anywhere from about 4.7% to almost 13%. It has a Sharpe ratio of 1.29, which is good, but not great. And it gives a Sortino ratio of 3.89, which is very good. It has a 4-star rating according to Fidelity. The returns are a little bit above average overall. The expenses are lower, more towards average, but the risk still stays awfully low. This fund's composition is a little bit more diversified than the previous one. It also stays around that 1% mark in cash, but this fund has 25% preferred stock and almost 25% in convertibles. But like the previous bond, previous fund, this bond is made up of a significant portion of domestic bonds. And looking over to the management of our portfolio over time, with these stocks, we will hold on to our stocks until they reach that fair value price. And when/if they do reach that price, we will have a limit order set to sell these stocks at that price in order to gain our total returns on them. And then after that limit order is executed, we will reinvest the funds gained into our two funds in equal weight. Looking at the bonds, we will just hold our bonds until their expiration date in 2049, which is consistent with our timeline. So we are looking good on the bonds, and with the funds, we will just hold them in our funds and try to stay consistent with our funds and going towards that average annual return that we are predicting with them at around 8 to 9%. We do this based on the low risk associated with both of those funds, and so that gives us a very good basis point with about 88.4% of our money invested in very low risk securities. We can kind of look at our scenarios with this investment. Our best case scenario, we look at an annual return based on our investments of about 5.73%. And so with our starting value of $100,000, that gives us an ending value of $531,000, which is, over 25% over our $425,000 goal. Looking at the worst case scenario with our fund allocation, we look at an annual return of about 5%. And this is how we got those crazy numbers in the percentage of how we invest. Because with our bond and fund risk being so low, we can basically assume that we will hit that return. And so even if our stocks absolutely tank out, we can still hit that 5% return. And with that 5% return, starting at $100,000, our ending value will still be over our target goal, sitting at over $432,000. Obviously, our best case scenario is infinite if our bonds and our funds just exceed expectations, and our worst case scenario is zero if everything absolutely tanks. The United States economy absolutely tanks to zero. But we're looking at our most realistic best case and worst case scenarios. Looking at it in graph form now, we can see the gradual growth of our investment based on our best and worst case scenarios. We can see gradual growth becoming exponential towards those end of those years, and they see both of them obviously gaining our investment goals. In all, we see our investment being very successful overall, and we see that we hit our investment goals 100% based on our most realistic best and worst case scenarios. Here are my works cited for this project, and then my images cited there. Thank you guys for listening to my final project. Thanks for a great semester, and I hope to see you guys soon.